Car finance. So many people nowadays have cars on finance. Gone are the days where people typically save up to buy cars, go out and buy them cash. Consumer finance is on the up. There are more and more companies offering consumer finance on vehicles. It's becoming a huge market, and people like myself, yourself, if you're in the market, are the product they are selling to us. It's quite a minefield. What are the different types of finance? What is best for me in my situation? And how do I choose the best product? Well, let's flip the lid off of what they are. Let's go for a drive. The world of car finance is getting complex. Arguably, it's also getting easier to get into. Interest rates are going up. It's a huge market. There is a huge industry in selling people, like myself, money to go and buy a car at a markup. If you've been keeping an eye on the finance market, if you're looking to finance a car yourself, at the point of recording this video, you will probably have noticed the interest rates have been sneaking up. Typically, if you're looking with a good credit score to purchase a vehicle, you'll be looking anywhere north of about 10.9% APR right now. In some cases, you could even see up to 15%. Now, I must stress, this is not financial advice. Mr. GB does not have the insurance to be dishing out financial advice. However, I am just going to give you here what I have learned as I've been looking at car finance myself, what I've picked up along the way, and how you can try and make the most out of any deals that you're looking to strike. So typically, with used vehicles, you have three main ways of financing a car. PCP, personal contract purchase. You have HP, hire purchase, and you have conditional sale, CS. Now these three things are different ways to borrow money to purchase a used or sometimes a new vehicle. If you're looking for a new vehicle, you can lease. This is very similar to a PCP, but without the option to purchase necessarily at the end. So let's flip back the lid on what these different types of finance are and what might be best for anyone in my situation. First up, I'm going to talk about PCP. Anyone who's watched my recent videos will know I purchased the Range Rover on a PCP agreement, personal contract purchase. Now, when you go and sit down in a dealership or a car sales showroom, whatever it is, they'll be throwing lots of numbers at you. They'll be trying to baffle you. They'll be saying, if you put this much of a deposit down and you make this many payments and we move the balloon payment at the end of that agreement, they'll be moving all of those around to give you a monthly figure that you are happy with. So what is that balloon payment? With a PCP, you place a deposit, you make some monthly payments, and then there's an option to purchase at the end, the final balloon payment. That balloon payment is effectively your choice point. Do I buy the car for the agreed value, or do I sell it back to the dealership that I bought it from at the agreed value? And what that means is you pay some monthly payments, and at the end of that term you've got the choice. You either keep the car with that agreed value, or you flip it back at the agreed buyback value, knowing that whatever's happened in the market, you've got a guaranteed sum for that vehicle. Now, the reason I purchased the Range Rover on a PCP, anyone who's been following Range Rovers will know as a volatile market, and I don't want to keep that car. So for me, placing a deposit, paying a reduced monthly payment because I'm not financing the full value of the car, I've got that balloon at the end that I'm not financing, means I can hop into a nice car for a relatively low monthly payment. Now, on the flip side of that, you have what is called a hire purchase. Now, a hire purchase agreement doesn't have a balloon at the end. You have higher monthly payments which get you all the way through the value of that car at a higher monthly rate without a balloon at the end, so you own the car at the end. Now, there are some advantages for this if you're buying for a business, for example. If you have an option to purchase at the end, It's very different to owning the asset outright, and you can put it above your bottom line, but that's a whole different conversation for business owners. If we're talking about consumer finance, it's a quicker way to own the equity in your car, but you have higher monthly payments. If you're just looking to hop into a good car for the minimal amount of money, it could well be hire purchase is not for you. Now, what are the pros of hire purchase over PCP? As I've said, you clear down the equity in the car. You don't have that balloon payment at the end, which means the car is yours at the end of the term. This car, the F-Type, is on a hire purchase. We own the car at the end of the term with nothing left to pay. There's a £10 option to purchase fee, which is a formality in the paperwork I'll come on to shortly. However, at the end of the term, this car is ours. We can do what we want with it. We've cleared down most of the finance, and when you're paying down consumer finance, all of the interest is loaded onto the front end. So your first year, for example, make up the number there, your first year is spent paying off interest. So if you came to sell your car, the chances are you would either be in negative equity or at a break-even point. Now, we're so far through the finance agreement on this car, we've actually got some good equity in the vehicle, which means at that point you can look at part Xing the vehicle, selling it, clearing down the finance and using it for a down payment on another vehicle. So it does give you more options because you're clearing down the equity in the car quicker than you would on a PCP. So they're the upsides. But what are the downsides of hire purchase against the PCP? Well, yes, very good question. You are taking out a higher line of credit. You're borrowing a higher amount of money because you haven't got that balloon payment at the end. So depending on your credit score, you might take quite a hit. Depends what you use to measure your credit. Again, this is not financial advice. Personally, I use Experian, Credit Karma and ClearScore. Chances are if you go into any finance house, they are the three main credit agencies they will use to check your score. Other downsides of PCP over HP will be that you spend a bit more time clearing down that initial interest. So the interest is front loaded on policies, and because you're making lower monthly payments, it takes longer to get through the interest. So if your circumstances change and you want to move out of a vehicle, it's going to take you a little bit longer to get to a point where you're in positive equity and you're in a position where you can move that car on without having to pay into a finance scheme that you are no longer owning the vehicle for. That's not a good position to be in. And I have touched upon that in my Range Rover insurance video, where some owners can't insure their vehicle. The insurance has just become too expensive. They're in a policy where they are not the right side of the interest, so they're in negative equity in their vehicle, and they're stuck with a car that they can't insure, that they're paying monthly payments on, and they can no longer get enjoyment out of. It's not a good position to be in. So why have I taken out cars on two different types of finance? Yeah, that is a great question. And actually, the Range Rover and this were very similar purchase prices. They were both mid-40s, mid to late 40s in the purchase price, but the monthly payments are drastically different. Both had the same deposit put down, and I will talk about this. I've been very hesitant to do this in the past. I don't ever want to come across as crude in what I discuss, but for the purposes of education, I'm happy to share this. Both cars had a £6,000 deposit placed on them. The Range Rover, we are paying shade over £500 a month for. This car, we are paying just under £1,100 a month, £1,100. Two very different figures, drastically different figures, but two very different finance examples. We are paying down this car a lot quicker than we would the Range Rover. So as I film this video today, we've probably got about £20,000 of equity in this car. So if we want to move this on and sell it and move into something else, I can sell it, clear down what's left on the finance, can't remember the settlement figure, and I'll have £20,000 to either invest in the markets, put down into the house, or do whatever I want with, or even move into another vehicle. The Range Rover, we are very much the wrong side of the finance still. Granted, we've had this car for 2 years longer than the Range Rover. We've been clearing down the finance for 2 years more. However, we've been paying into that PCP agreement on the Range Rover for 1 year, and we still owe more than the purchase price of the car. Now, I'm not upset about that. I knew that when I was buying the car. Don't intend to keep it. Going to hand it back at the end of the PCP agreement and move into something else. So that hopefully gives you a good comparison on how the two different types of finance clear down. Now, the third and final type of finance that we need to talk about, and I've touched on it and I haven't done a lot with it since, is CS, Conditional Sale. Now, on the surface, CS and HP, hire purchase, conditional sale, seem very similar. You make a monthly payment after a deposit and there's no balloon at the end. You effectively have the car at the end without making a huge lump sum payment. And as I say, on the surface they seem very similar. However, there are subtle differences between the two. And I cannot stress enough, this is not financial advice. This is just my learning as I've been going through the same journey you're probably on if you're watching this video. Well, CS, conditional sale, ownership of the car automatically transfers to you at the end of the agreement. It's a small detail, but an important one nonetheless. Hire purchase means you must make a final option to purchase payments. Now, they're often small. They can be £10, £100, comparatively small to the big balloon at the end of a PCP agreement, for example. But what it means is there is that legal agreement between yourself and the financer to say, this car is transferring to you, or you say to the financer, you are having the car back. So if you take the finance deal without the final option to purchase payment, the car comes to me at the end of that agreement when I finish making my payments. That's mine to do as I wish with. If I take the deal where I have to make a payment to the finance house at the end, I can either hand the car back to them and they buy it off me, but there could be some arguing around what the car's worth. They would pay trade price, whereas I'd be looking at private sale or retail price. And it means that I probably at that point, if I had no intention of keeping the car, would have been better moving into a PCP where I agree that final sale price, i.e. the balloon payment at the end. Hopefully that has gone some way into explaining what the different types of consumer finance are. Now, again, I keep saying it, so I don't want people to get angry at me in the comments. This is not financial advice, so please go and do your own research. This is purely my whimsical thinking out loud on a video on YouTube. If you're uncertain, go and speak to a specialist. But these were the questions I had when I was in the market, and these are the questions I struggled to find the answers to from someone who's straight talking, who can just give it to me as a consumer. So hopefully it helps. Hopefully it's gone some way into aiding your purchase of your next vehicle. And hopefully if you've enjoyed the video, you're going to hit that sub button down below and stick around for the next one. See you then. Peace, guys. That was a worrying clunk that came from the gearbox there when I downshifted. It goes in for a service in a couple of weeks. We'll worry about that then. We'll make it someone else's problem.